Hi guys. Okay, we are heading into the home stretch here. We want to go ahead and look at chapter 21. Some of you had asked to look at those slides, so we're going to do that. And we'll understand here accounting for leases. Okay. Now, what we're going to see is that there are some transactions that FASB have looked at, and they've determined these are going to be accounted for as though the entity in legal substance is just leasing the property, but the economic reality is that they're purchasing the property. And so when a lease meets certain criteria, we're going to see that that's going to qualify as a finance lease, and we're going to treat that as though that was a purchase by the lessee. That's the person essentially leasing or renting the, say, equipment or whatever the asset is, versus, and for the lessor, it's going to be as though they're selling it, versus an operating lease, which is more like a traditional way that we think of leases, the legal way we think of leases, that we're just renting that property. So depending on what criteria, we're going to see that a lease will be treated as a finance lease, more like a purchase, more like a sale, or more like a rental agreement if it is an operating lease. And then we'll take a look a little bit at some of the reporting requirements associated with that. So one of our big tasks is going to be able to figure out whether a lease is going to be a finance lease or an operating lease. We're going to have to understand that criteria. And then, of course, we're going to have to understand the accounting around that. Now, if we are dealing with a finance lease, okay, for a finance lease, we're going to see that we're going to have interest expense and we're going to have amortization expense, which is essentially like our depreciation on something called a right of use asset. So when we take that asset onto the books because we've met the criteria for a financing lease, we're going to bring on the books a right of use asset, and we're going to amortize that pretty much probably using straight line. That would be like our depreciation, but we'll also have to recognize some interest expense at that point in time as we amortize the liability. Regardless of whether we have a finance or operating lease, we will always capitalize the asset and the liability. It's just a matter as to how we're going to amortize that, how we're going to depreciate that asset and that liability that we will bring on the books, regardless of whether it's a finance lease or an operating lease. Okay. If we have an operating lease, we're going to treat that a little bit differently, and that we will still amortize, okay, measure interest expense. However, as we amortize the right of use asset, we're going to amortize it in the same manner that we would amortize the liability. Thus, what will end up happening is the amount of cash that we pay out on that operating lease from period to period will essentially constitute our lease expense that we'll report on the income statement. We'll show that as a single number, single lease expense. Okay, so just an overview here, and notice that from the lessee's perspective, we have a finance lease if there's something to indicate that the lessee is taking ownership of that, or if they are consuming substantial portion of their underlying asset over the lease term. Now, those are some two broad criteria that we're going to be looking at here, but what we're going to see is they're going to give us some more detailed ways of determining whether or not we have an operating lease. So even though we have these two broad concepts here, we're going to see that we're going to get a little more granular, and let's start to take a look at this on this sort of decision tree here. Okay, so for the transfer of ownership test, one easy one is, does the lease call, and by the way, we only have to meet one of these 5 tests, okay, and of course it has to be a non-cancelable lease, and then you start to get into one of these 5 tests. If the answer is yes to any one of these, we have a finance lease, and that's going to dictate our accounting for that. Okay, so does the lease transfer ownership? If there's something that says that at the end of the lease, the ownership transfers over to the lessee. The lessee is the person renting the equipment, essentially. The lessor is the one selling the equipment, if you will, or leasing that equipment out to the lessee. So if there is a transfer of ownership, the lessee is going to get the ownership at the end of that. You don't have to ask yourself any more questions. We have a finance lease. We will follow the finance lease accounting. Okay. If we don't meet that criteria, then is there a purchase option? And if it seems likely that the lessee is going to take advantage of that purchase option, for example, let's say it's a bargain purchase, then we will go ahead and count that as a finance lease. Okay. Lease term test. Are we leasing the asset for substantially most of its economic life? And we're going to see that they've given us a guideline there that if you're leasing it for 75% or more of its economic life, you can determine that it is a finance lease, and you will do the accounting for a finance lease. Okay. Next option. Okay, we only have to meet one of these. Does the present value of the sum of the lease payments and any lessee residual value guaranteed, any lease residual value guaranteed not reflected in the lease payments equal or exceed substantially all of the underlying asset? And they're going to give us some guideline there that that's going to be a 90% test. So if the sum of those payments are greater than or equal to 90% of the fair market value of the property, then we're going to say, hey, that's met a criteria for a finance lease, and we'll treat it as a finance lease. And then alternative use test. If the asset is constructed in such a way that only the lessee can use it, then maybe they've built me some equipment to my specifications, or a building to my specifications, and only I can use it. There's no alternative use to that. Then that will qualify as a financing lease. Okay, now if we don't meet any of these criteria, then we go to operating lease. So it's either finance lease or operating lease, but any one of these criteria will cause it to be considered a finance lease. And depending on where we end up, operating or finance, that will dictate much of our accounting here. Okay, so you start to take a look at some of these items now that we saw in that little checklist. And let's go ahead and put highlighter here. And let's take a look at some of these. Okay, so transfer of ownership test. If the lease transfers ownership of the asset, then it's a finance lease. I mean, that's sort of a common sense sort of criteria, because we're looking to see, hey, should we be treating this more as a purchase or a rental agreement? Well, if you're going to end up with the property at the end of the lease, then it's more like a purchase. Okay, purchase option. The lessee purchase option allows the lessee to purchase the property for a price that is significantly lower than the underlying asset's expected fair value. In other words, there's some sort of bargain purchase. And if you think about that, that's logical in that, hey, look, why wouldn't you buy something at the end of the lease term for $5,000 if its economic life is substantially more than $5,000? Even if you didn't want the thing, you could turn around and do what? Sell it and get some money out of it. And so we say, hey, you're essentially purchasing that if there's a bargain purchase option at the end, and we will treat that as a financing lease. Okay, lease term test, as we've said, I kind of alluded to there a minute ago. If the term of the lease is greater than or equal to 75% of the economic life of the asset, then it is considered a finance lease. And then notice that if there's a bargain renewal option, that can extend that period. So let's say we're sitting here and, hey, we've got a lease term for 2 years, but then we are able to extend that at a bargain rate for another 2 years, then the term of that lease would be 4 years in that example. Okay, good. So let's go ahead and take a look at the present value test. Okay, when we do this, we're going to take a look at the lease payments. Any lease consideration you do, question that you get on your exams in the practice midterm that we're going to look at later, we're going to see that we're always going to pick up the annual payments. Usually is what they say in these lease questions. You have to pick those up, okay? If there is a variable payment, it has to be based on an index or a rate, okay? So if they say, hey, the lease payments are going to be based on the consumer price index, going forward, because maybe the lessor wants to protect themselves against inflation or something, then yeah, we would pick up those index payments at what we think the index is going to be. If it's based on some sort of use, like if you go over so many miles or something, then we don't assume that we're going to go over those miles. We wait to see if we go over that, and then those overages become an expense of the time that we actually go over, okay? If there's guaranteed residual value, we pick that up in order to determine the present value of the lease payment. So we assume guaranteed residual value says, you guarantee me that this property is going to be worth $5,000. I don't know why I'm always picking 5,000 at the end of the lease term. Well, if you're in a situation there where you're going to say beat the property up and it's only going to be worth $2,000, then the presumption is, hey, you're going to have to pay that $5,000 to bring me back whole, or 2 plus 3, whatever. So whatever that guaranteed residual value is, for the purposes of determining if the lease payments meet the 90% test, you would include those payments, okay? And then payments related to purchase or termination options that the leasee is reasonably certain to exercise. All of these payments would be included. We'd have to get the present value of those and then compare that to the fair market value of the property. And if those present value of those payments is greater than or equal to 90% of the fair market value of the property, we essentially have determined that we've met the present value test, and we would treat that as a financing lease. Okay, good. So this one is going to help us to understand a little bit better how a bargain extension option on the lease would affect the term of the lease. So we have this Home Depot leases Dell PCs for 2 years at a rental of $100 per month per computer, and subsequently can lease them for $10 per month per computer for another 2 years. And the thing said, what is the number of years? Blank years. That's 4 years. The first 2 years plus the $10 would constitute a bargain renewal option. And so we would assume that we're going to go ahead and take that, and we would put the lease term to be 4 years in that case. Okay. All right, good. So let's start to take a look at the potential as to what our discount rate could be in this scenario. Okay, so as we look at the discount, it's worthwhile to understand, well, why do we need a discount rate? Well, since we're doing the present value test, we'll need a discount rate that we'll have to use for these. Okay, now generally we will use the rate that's implicit in the lease. Okay, so whatever the rate is that's in the lease, that's what we'll pick up and we'll use as our discount rate. It is possible. Sometimes the way they write up these leasing agreements, it's difficult to ascertain what the rate is that's implicit in the lease. And if that's the case, then the leasee is going to use whatever their incremental borrowing rate is. Okay, so they'd have to look to their own rate and determine what their borrowing rate is, and that's the rate that they would use for the discount rate. Sometimes lease agreements are written in such a way that it is difficult to determine what the rate implicit in the lease is. So try to use the rate implicit in the lease. Many of the questions will call that out, but if they say that the leasee doesn't know that rate, then you would have to use the second rate that you'd have to receive in the information to be able to answer that question, whatever the incremental rate is that's available to the leasee. And then the alternative use test, if at the end of the lease term the lessor does not have an alternative use for the asset, then we'll classify it as a financing lease, probably because they've developed that piece of equipment, whatever, specifically for my use, and so they're not going to be able to use it for anything else. Then that constitutes essentially I'm purchasing that, and that would constitute a finance lease. Okay, so let's go ahead and take a look at this, how we're going to count for a finance lease. And let's just take a look now at this example here. And so we're going to use this example to illustrate the accounting for a finance lease. Assume that Caterpillar Financial Services Corp., a subsidiary of Caterpillar, and Sterling Construction sign a lease agreement dated January 1st, 2020 that calls for Caterpillar to lease a backhoe to Sterling beginning January 1st, 2020. The terms and the provision of the lease and agreement and other pertinent data are as follows. So we're going to look at what they give us here, and we're going to see if we're going to treat this as a finance lease. And okay guys, I'm gonna have to stop that now. And so we're going to basically want to look and see if we meet the criteria for a finance lease. If we do, then we'll go ahead and account for that as a finance lease. So you take a look and they repeat the criteria up here for us, but let's just go ahead, not the criteria but the fact pattern up here, and then they start to give us some information about this lease. And so they tell us here that the term of the lease is 5 years. The lease agreement is not cancelable, requiring equal rental payments of $20,711.11 at the beginning of each year. The backhoe has a fair value at the commencement of the lease. Okay guys, this thing's going to go ahead and keep annoying me. I don't know why I have to sign into this when I've been using this software for a long time. Okay, but let's just go ahead and see if they don't bother us with that again. Otherwise we have to pause and give it the password. Okay, so there's the information about the lease. The backhoe has a fair value of the commencement of the lease of $100,000, an estimated economic life of 5 years, guaranteed residual value of $5,000, and Sterling expects that it is probable that the expected value, the residual value at the end of the lease, will be greater than the guaranteed amount. Now, this is going to be interesting because to determine if we have a finance lease, we will include that payment, but when we actually calculate the right of use asset, we won't include that payment for that reason that they don't think they're going to have to give up that cash, because they think they're going to just turn the equipment back and it's going to be worth that $5,000. So it's a little bit of an interesting treatment that FASB has there, is they have us use it to determine if we have a finance lease, but then they don't make us include it when we calculate the actual lease right of use asset. You'll see what I'm talking about here as we move forward. The lease contains no renewal option. Okay, so we know that there's none of these bargain purchase options. They tell us their incremental rate. Sterling depreciates their assets on a straight line basis, because remember, we're not only going to amortize the liability portion, but we're also going to amortize or depreciate the asset, because it is as though we own it, and we're going to use straight line for that. And then Caterpillar sets the annual rental rate to earn a rate of return of 4%, and Sterling, who's the lessee here, sometimes have the battle with these questions is remembering who's the lessor, who's the lessee. Sterling is aware of that rate. That being the case, we will not have to use Sterling's incremental rate, because we're aware of the rate that the lessor, Caterpillar in this case, is using, and that's implicit in the lease. Okay, all right, but let's just go through the criteria here. There was no transfer of ownership. There was no purchase option. Okay, none of these bargain purchase options in there. But what happened? The lease term was 5 years, and the economic life of the property was 5 years. Okay, so I don't know where they gave that to us. Let's see. The lease agreement is non-cancelable, requiring equal payments at the beginning of the year. Okay, estimated economic life of 5 years, and the term of the lease is 5 years. Okay, so sometimes you want to need to pick that information out. Now, when you look, they continue on with the evaluation here, but once you met one of these, it is a finance lease and will be treated as such. Now we're going to look at the present value calculation here in a minute, but we met the present value is, in this case, equal to the fair market value, and it only has to be 90% or more. It's 100%. So yes, we have a finance lease on that criteria as well, but it doesn't matter. Once you meet one, you don't care about the others. And then we didn't hear that there was the asset is returned to Caterpillar with some residual value, so there is an alternative use, but it doesn't matter. This is just kind of systematically going through the criteria here, because we know that if you meet one, you do indeed have a finance lease. So now we can go ahead over to the next slide, and we can start to take a look at how we're going to apply the now that we know that we have a finance lease, how we're going to apply that information to do the accounting for that finance lease. And we'll do it from the standpoint of the lessee and then from the lessor. Okay, so let's go ahead and let's just take a look at the accounting now for the lessee. And you're going to see that the accounting is actually pretty straightforward. Now, the first thing we need to do is figure out, well, what is the present value of those lease payments? And remember, the problem told us is $20,711.11 at the beginning of each period. Okay, so we pick up the present value factor and present value, and it would be present value of an annuity due because it's beginning of the period payment. So we'd pick up that factor, and then that would give us the present value of the lease payments. Now notice that's saying $95,890, and you're like, wait a minute, I thought the previous slide said the present value of the lease payments was $100,000. Well, that was because they included the present value of the $5,000 guaranteed residual value, and you do include that to see if you've met the fair value being greater than or equal to 90% test, the present value test. You don't use it to do the accounting when the lessee believes that the value is the property is going to actually have a higher value than that $5,000. Then they're saying, well, I'm probably not going to have to pay that out. So you use it to determine if you have met the present value test, but you don't use it in the calculation of the actual accounting unless the situation was that the property is going to be worth less than the $5,000 guaranteed residual value at the end. And then let's say you feel, well, we're going to really use this thing. It's probably going to only be used worth $2,000. I got a guaranteed residual of $5,000, so I'm going to have to cough up $3,000. Then to do the accounting, you would take the present value of the $3,000 that you think you're going to have to pay at the end of that lease. So if you're going to really use that a lot, then you'd have to assume that you're going to have to make up that difference, whatever it is, and you would include it here. But here, since they felt, hey, it's going to be worth more than the $5,000, we're just going to turn it back to them, then you don't have to include that here in this calculation. Okay. Now again, we use the 4%, as I said earlier, so that's where they came up with that factor. Okay, now we come over and we just take a look at the initial entry, which is to debit the asset, debit the liability. We call that a right of use asset. So we debit an asset and a liability simultaneously. Now, when we go ahead and we make that first payment, which is at the very beginning of the lease, all of it goes towards the lease liability because there has been no time for any interest to accrue because we leased the property January 1st and we made that first payment. So it's almost like a down payment, right? Okay, so that all goes against the liability. Then what? Then we have this carrying value of that lease liability for the first full year of the lease. And the interest rate on that is what, 0.04 that we use, and that now yields an interest expense of $3,007.17. So at December 31st of that first year, we go ahead and we set up the interest payable, we debit the interest expense. Now we're going to make that first payment the next day, January 1st. Okay, when we make that payment, $3,017.17 of it is going to, of course, go to pay the interest payable, and the remaining $17,703 is going to go against the principal, so that I'll have a new carrying value of that for the next year. Okay, and then whatever the carrying value is, we multiply it times that 0.04. So for the next year now, we're going to accrue interest of 229.01. We always pay that $20,711.11, so that we have $18,000 that goes towards the principal, and so on as we amortize the liability. Very similar, guys, to what we did when we were using the effective interest method to amortize our bonds, right? Remember back when we talked about bonds a few chapters back, okay? Okay, good. So we go ahead and we set up the amortization expense as we go ahead and use straight line depreciation, essentially. They call it amortization expense, but look, guys, it's straight line depreciation that you would make each year as you use that asset. Okay, and if you take a look at the financial statement results here, notice we have what? We have the current liability is that first payment we're going to make, or that second payment we'll make in 2021, January 1st, 2021, right? The non-current portion, of course, is those parts we, a non-current asset, of course, is net of the amortization that we've taken, and then we also have the non-current portion of the lease liability, right? Okay, then on our income statement, we have interest expense and we have our amortization expense from the right of use asset, which is basically like depreciation expense. Okay, no more complicated than depreciation. Now we continue on making the payments, and this is a little irritating. You know, I really think that the textbook should have been a little more careful here. This should be $17,703.94 that goes to the lease liability. And then remember, we did at December 31st of the previous year set up interest payable, remember? So if we were showing interest payable, right, they showed us that we showed that on the interest expense. Okay, we have our lease liability here. At some point we would have had to, if we set up interest payable, because they didn't credit the lease liability, if we set up interest payable, at some point we'd have to close that interest payable into this lease liability. So maybe that's the point, and maybe I don't have to change it. If they did this, if they set up the interest payable, at some point you would have had to have closed that to lease liability. So maybe here they should have credited lease liability, whatever. If it's going to end up being reported as a lease liability here, the two amounts together, then you would have had to take it out of lease payable and put it into interest payable, put it into lease liability. And if you did that, then yeah, then you could go ahead and debit the lease liability for the interest plus the principal portion and credit the cash. So they should have been a little more careful there. Don't show me a payable and then show me, you know, debiting a lease payable liability later on if you haven't taken that interest payable portion and put it into the lease liability. Bottom line, it is interest expense, though, is reported as interest expense at the end of the first year of the lease. Okay, good. Now, assuming that they decided to go ahead and buy that property at the end because they had completely amortized that lease liability down to zero, because remember, the $5,000 was not included in the calculation of the present value. But then if they changed their mind or said, hey, we're going to go ahead and buy this thing, then it's very simple. You debit the equipment for the $5,000 and you credit the cash, assuming that that's what they were able to purchase it for at that point in time. Okay, so let's go ahead and take a look, and we're going to basically be using the same factors that we looked at, same information that we looked at from the standpoint of the lessee, now from the lessor. Okay, now again, the criteria we're going to go through, but we're going to see that the criteria is essentially the same for the lessor and the lessee to see if it qualifies as a finance lease. And when we look at finance lease from the standpoint of the lessor, there are two types of finance lease. In this class, we're going to focus on the sale type lease. There is also, you may have seen in the text, something called a direct financing lease. If it's a direct financing lease, then the only property that, the only profit that the lessor is considering is just a financing piece. They call that a direct financing lease. We're going to just focus on sale type lease for our finance leases, in which for the sales type lease, there'll be two profits. There'll be the profit from the interest that's earned on this, but there'll also be a profit on the sale because we're going to sell this equipment, in this case with this Sterling and Caterpillar. Caterpillar in this example is going to want to sell this property at a profit, and so they'll have the profit and the interest, and we'll see how that'll work. And that's what we'll focus on in this class, sales type lease. You may see one of the appendices in the book there, direct financing lease. We won't deal with that this term. We'll just deal with the sales type lease. Okay, all right, good. So you take a look, and we're going to basically look as though we are going to sell the property. Okay, the lessor generally records a lease receivable and eliminates the leased asset, and the lease receivable, okay, is going to be the present value of rental payments plus the present value of guaranteed and unguaranteed residual values. Of course, they should say or. Can't really be both. It can't be guaranteed and unguaranteed. From problem to problem, it could be guaranteed or unguaranteed. So they probably should have put or there. Okay. But basically what we're saying with these residual values is, look, if the residual value is guaranteed, then you're going to get some cash back at the end of that because they've guaranteed that they're going to pay you that at the end. If it is what? If it is unguaranteed, then what they're basically saying is you're going to get the equipment back. So the receivables are really what? Money. But it could also be what that's supposed to be, guys, equipment. Okay, I don't know what kind of equipment that is, but it could also be a machinery. I was trying to make a machine there. Okay, it could also be machinery. It could be the equipment itself that you're going to get back. Whatever, it's a receivable, and you're going to take the present value of those to set up your lease receivable, and then we're going to be doing the mirror image of what we saw for the lessee. For the lessor, every time we make a payment, some of it will constitute not interest expense but interest revenue. Some of it will be a pay down on the carrying amount of essentially what's a loan to them. Okay, so we come over and let's just take a look, and they tell us that the term of the lease is 5 years, non-cancelable, same exact thing that we talked about it's the same transaction, just the other side of the transaction. Let's go ahead though and let's take a look here. The backhoe has a fair value at the commencement of the lease of $100,000, an estimated economic life of 5 years, residual value of $5,000, which is less than the expected residual value of the backhoe at the end of the lease. Now that's a little bit different now, because what they're saying is, hey, you're essentially going to get that equipment back, and you just go ahead and assume that the guaranteed residual value is going to be kicked back to you in terms of either the equipment or some money. Further, assume that the underlying asset, the backhoe, has an $85,000 cost to Caterpillar. There's no renewal options. The backhoe reverts to Caterpillar at the termination of the lease. And this is something that the lessor does have to consider, which is the collectability of the payments in order to treat this as a finance lease. So even though we said the criteria is essentially the same, the lessor does, to treat it as a sales lease, have to consider the collection of the payments are reasonably expected, which we see that as criteria in any sale. For the seller has to do that. So that's something that the leasee wouldn't worry about, that the seller would have to consider here. Okay, so as we look at the numbers now that we've seen that we've met the criteria for a sales type lease for the lessor now, notice that we're looking at the fair value of the equipment, okay, and then we're going to take the present value of that the residual value, and the notion here is that they're going to it's a guaranteed residual value. I'm sure I want to say that correctly. But we're essentially going to assume that we're going to get the equipment back at the end. So the present value of what we're giving up here is not the $100,000, because we're going to get, although it be 5 years down the line at the end of the lease, we will get that equipment back. So since that equipment we're thinking is going to be worth $5,000, and we're going to multiply that times the present value factor, we subtract that off. Okay, that gives us a present value of $95,890. Now what you would do is you would go to the present value of the annuity factor for that and divide that present value of the annuity factor. You'd go to 5 years, 4%. You'd find that factor. You would divide that by the $95,890, and that's how you come up with the annual payments. In the lessee standpoint, the lessor would provide that information. That would be part of the deal, but it would probably be the lessor that would be drawing up that contract and come up with that amount. That's why they showed it to you that way. Okay, so that's the lease payment, just like it was for the lessee that we saw earlier. And you can see that we have met the criteria for the direct financing lease here. I mean, excuse me, not the direct finance lease, for the sale type lease. It's a finance lease, but it's a sales type lease because the present value of the lease payment is equal to the fair value, and the lease term is equal to the economic life. And we're going to see that they're going to basically have two profits here, because they're going to sell it. They're selling it for less than its cost. Okay, so they go ahead and they have the present value of the lease payments, the present value of the $5,000, the equipment they're going to get back. So the journal entry at the time that we sell this property is to set up the lease receivable of $100,000, set up the sales revenue of $100,000, debit the cost of goods sold, and credit the inventory, because back a couple slides ago they told us that the equipment had a cost of $85,000. So we have now $15,000 of gross profit on this thing, and then we're going to slowly recognize the interest part of the profit over the term of the lease. So we go ahead, and it's the mirror image now. The first payment, of course, all goes towards the lease receivable, and then we're going to continue to calculate. And now, instead of it being interest expense, I said we're going to continue to calculate. We're going to do the mirror image of what we calculated before. Instead of it being interest expense, now it's going to be what? It's going to be interest revenue each time as we multiply that times the 4%. Okay, so I'm getting some wobble on my tablet here for some reason. Okay, so we go ahead and we start to take a look at that. At the end of the first year, they set up the lease receivable. Instead of it being interest expense, now it's interest revenue. Okay, and then we go ahead and we show our balance sheet. There's our lease receivable. Okay, there's the non-current portion, which is the balance there, right? Just looking at the amortization table, that's the amount that we're going to get in future periods. Okay, And then, of course, we have our revenue minus our cost of goods sold would be our gross profit, 15,000. They could show that if they wanted to. And then the interest revenue that we just recorded. Okay, and then when we go ahead and make that second payment now, right, the first one all went towards principal. This one now will go towards the portion, will go towards the lease receivable, because we set that up as our interest, and then we'll go ahead and at the end of the next year set up our interest revenue, adding that to the lease receivable. So they add the interest revenue to the lease receivable as each payment pays down on the lease receivable. Okay, and then we have that last payment that's going to come in, and when that comes in, then we will go ahead and reduce the lease receivable down to 0, and then it turns out that they get the equipment back, which was sort of predicted that was going to be the case, that they would get the equipment back. So they debit the inventory, they credit the lease receivable, because they're essentially getting that equipment back now, and it's now 5 years later. Remember, its present value was less than that, but after 5 years it had built up to the 5,000, and we credit the lease receivable for that. Okay, good. That takes care of the lessor for the sale type lease. So now we can go ahead and start to turn our attention towards operating leases. So let's see how those are going to work. And those are fairly straightforward. It's just going to be like a rental agreement. So let's take a look. Okay, so let's go ahead and take a look now at the example they give us here for the operating lease. And we're going to see that we're going to review the criteria again. And of course, there's basically one criteria. Any time you don't meet any of the criteria, then it's an operating lease. So operating lease is sort of what you go to once you haven't met any of the criteria for the finance lease. Okay, so that's basically what we're saying here. However, we're going to see that as we make the lease payments, we're going to treat the entire amount as, not as we make the payments, but at the end of the year as we amortize the lease liability, we're going to see that amount is actually going to be a reduction of the right of use asset, and the entire amount, whatever our interest expense is, plus the amortization of the right of use asset, that entire amount will be recognized as one amount, lease expense. So let's go ahead and take a look at this example. And we have this Joss Way and Taylor stores. Taylor is the lessee. Joss Way is the lessor. We're going to deal with the lessee first, Taylor here. Okay, sign a lease agreement dated January 1st, 2020. The lease agreement specifies that Joss Way will grant a right of use of one of its standard cardboard compactors, not specialized, so it's not going to meet. We know already we can knock off the alternative use test. We're not going to meet that one, so we know that this is going to be an operating lease anyway. But taking a look at the information, the lease is non-cancelable with a term of 3 years. Okay, so the term is 3 years. The compactor has a cost and fair value commencement. The lease of $60,000, estimated economic life of 5 years. There goes the 75% test. And a residual value at the end of the lease of $12,000 unguaranteed. The lease contains no renewal options. Okay, and again, this is kind of making this more scary than it has to be. And lift reverts to Joss Way at the term of the lease, so there's no transfer of ownership. So maybe the 90% criteria. Again, I'm kind of being silly here because we know it's an operating lease, so that's not going to work out either. We'll see why on the next slide. And then they give us the interest rate that we should use is 6%. So you take a look, and the fair value of the property is 60, and we're going to sit here and we're going to take off the present value of that residual value, because we're not buying that. That's going to go back to the lessor at the end. So really, we're paying for just the present value of the fair value after you consider that lessor value, right? So you'd go ahead and divide that by the present value of the annuity factor, 3 years for 6%. That gives us the payments that we're going to make on this. So now you start to go through the criteria, and we've seen that it was pretty explicit that we hadn't met those other ones. And then you can see the lease term test and the present value test, we didn't meet those either. So we have an operating lease, which we knew all along that was going to be the case. So let's go ahead and take a look at the journal entries for this one, okay? And so we go ahead and we set up the right of use asset and the lease liability, basically for the present value of what we're going to have to pay out on that lease. Now we know that we have to make those lease payments at the beginning of each period. Of course, the first payment all goes towards the liability. Now we're going to go ahead and now amortize our right of use asset, and basically the amortization of the right of use asset is going to be the amount that is the reduction in the lease liability period to period. So you can see that we debit our lease expense for the full amount of the payment, and then we're going to credit the right of use asset for the difference between the amount that's essentially interest, although we don't call it out as interest on our financial reports, but essentially the difference between the payment and the amount of interest is going to be the amortization of the right of use asset. So it's not like the straight line depreciation we saw earlier. And then of course the interest portion will increase that lease liability, so that when we make that next payment now on January 1st of the next year, we go ahead and we reduce the lease liability by the amount that we have paid, and we'll debit the lease liability for that amount and credit the cash, of course, at that point. So we're reducing the lease liability. It has a lower carrying amount, and we go ahead and calculate our interest on that next 12 months of interest. I think the interest rate was 6% on that, and we go ahead and set that up. Difference between the interest portion and the amount of payment is going to be the amortization of the right of use asset, and of course we add to the lease liability the interest expense, and we make that next payment and pay off that lease liability. So essentially the takeaway is what the amount of cash that we paid out, even though a portion of it we know in our heart was interest, right? We call it out as lease expense. Okay. All right, good. And then, of course, we go ahead and make that last payment to debit the lease expense, credit the right of use asset, and that will completely amortize that asset. Okay. Okay, let's go ahead and take a look. Okay, let's go ahead and take a look at this one now. And I think we need to fix something here. This is now the lessor, not leasee. Okay, so lessor. Now we're still doing it with operating lease, and it's basically still that same lease that we were talking about earlier, but now it's the lessor. Okay, so the lessor accounting is the same criteria. If we don't meet any of the financing lease requirements, then we treat it as an operating lease. Lessor does the same thing. This is a little confusing because they forgot to change these slides to lessor. We're doing the lessor's accounting now. And basically the lessor is going to receive that cash at the beginning of the period. All of it is unearned lease revenue. And then at the end of the year, they'll be able to take the earned, and they're going to do that consistently throughout the year. Now, of course, because they own the asset still, and that's an important point, they will depreciate the asset, and for some reason the book found it necessary to bring in double declining balance at this point in time. Just know whatever method, straight line, whatever they're going to be using, they're going to be depreciating that asset because they still own it. And then as they go along each year, they'll take that, as we've seen, the unearned revenue and the revenue as they go along. Okay. All right, good. So let's just take a look at a couple of additional factors, particularly dealing with executor costs that you can see on that next slide. Okay, so let's look at executory cost. Executory costs are basically payments that are made for the insurance or made for the tax on the asset, whatever different costs that you might make to keep say a vehicle maintained. You have to pay the licensing fees and that. And if those are going to be paid by the lessor, and the lessee is going to have to compensate the lessor as part of the lease payments, then they should be included. But if they're going to be paid directly by the lessee, then the lessee will go ahead and expense those as incurred. Any initial direct cost, okay, initial direct costs such as documentation preparation fees, legal fees, these sort of things, okay, those would be included in the lease payments. Things that should be excluded: advertising, negotiating lease terms and conditions. Okay, and you can take a look at and see the nature of what would be included in the payments as initial direct cost, and which would be excluded. Okay, and then if the lease term is shorter than 12 months, just treat those lease payments as expense, and you don't have to worry about the amortization, the setup of the right of use asset. Okay, just a few things there at the end. Key things to focus on, and we're going to look at some questions, are going to be the criteria that we looked at. And then once we've determined the criteria, how do we treat it as a finance lease from the standpoint of the lessee, a finance sales type lease from the standpoint of the lessor, and then again, if we don't meet any of those criteria, operating lease, lessee, lessor. Okay, just some of the basic things. And you'll see how those will turn out and look at some of the practice midterm questions here in a little while. Okay. All right, good, guys. We'll see you in a little while for the practice midterm.